Hello everyone, I'm pleased to welcome you to this webcast on the third edition of the IFRS for SMEs Accounting Standard. We'll be focusing on the revised Section 19 called Business Combinations and Goodwill. In this webcast, we'll explore the revised Section 19 of the standard, which has been updated to align with IFRS 3 Business Combinations using the IASB's alignment approach, which considers relevance to SMEs, simplicity, and faithful representation. We'll look at the key features of the revised section, including the new definition of a business. Then we'll walk through the acquisition method of accounting. We'll examine the main disclosure requirements in the section and finish with information about making the transition to the new standard. First, let's look at the key features of the section. Section 19 was previously aligned with IFRS 3 as issued in 2004. IFRS 3 was revised in 2008 and has since been amended. In the third edition of the standard, Section 19 is aligned with the current version of IFRS 3, including all recent amendments. The revised Section 19 introduces a new definition of a business and requires the acquisition method of accounting for a business combination. The section also includes new requirements relating to topics on which the standard was previously silent. For example, the section now includes requirements on what to do when a new entity is formed in a business combination and how to account for a business combination achieved in stages, also known as a step acquisition. The requirements for contingent consideration have been amended. We'll see how these work when we talk about determining the consideration transferred for a business combination. Finally, the amount recognized for consideration no longer includes acquisition-related costs. These costs will now be recognized in profit or loss unless they are in the scope of Section 11, Financial Instruments, or Section 22, Liabilities and Equity. The revised Section 19 only applies when an SME acquires a business. Often, SMEs will find it straightforward to determine whether they are acquiring a business. However, the new guidance can help in cases in which more judgment is necessary. The definition of a business, aligned with IFRS 3, has three elements: inputs to a process that is applied to those inputs, and outputs which are the result of those processes. All three of these elements should be present for the activities of the acquiree to meet the definition of a business. If this definition is not met, then this section does not apply. A simple example is an SME purchasing a manufacturing business. The inputs are raw materials, then the manufacturing process turns them into final inventory to be sold, the outputs. This would meet the definition of a business. However, if the SME purchased only a large quantity of finished goods ready to be sold to customers, there would not be clear inputs or processes, so the acquisition would probably not be a business combination. The new guidance provides SMEs with an optional concentration test, which simplifies the assessment of whether a set of activities acquired is a business. In other words, it helps SMEs to assess whether the definition is met. In applying the concentration test, an SME assesses whether the fair value of assets acquired is concentrated in a single asset or group of similar identifiable assets. For example, the purchase of an entity that owns a single building. If the answer is yes, the SME would conclude it is not in the scope of Section 19 and would apply the relevant sections of the standard to recognize the assets and liabilities purchased. If the optional concentration test is not met, or if the SME decides not to use the test, the SME assesses whether the three elements of a business are present. Usually, all three elements of a business would be present. But sometimes a set of activities can be classified as a business if only inputs and a substantive process are present. The new appendix to Section 19 provides guidance on how to determine if an acquired process is substantive. So, now we've looked at how to determine that an acquisition is a business combination. Let's look at how to apply the acquisition method. The method sets out 5 steps to follow in order, and we'll talk through each of these in turn. The first step is to identify the acquirer. In other words, the entity that obtains control of another entity or entities. Section 9, Consolidated and Separate Financial Statements, defines control, and the educational module on Section 9 provides further guidance and examples on control. If the SME is not able to clearly identify the acquirer after applying Section 9, then it shall look at the appendix to Section 19 that provides further guidance. Usually, the acquirer will be the entity that transfers cash or incurs liabilities, or the entity that issues shares, depending on how the business combination is structured. Similarly, if one of the combining entities is significantly larger than the other, the larger entity will be the acquirer. But sometimes, this will not be the case. For example, if a new entity is formed to effect a business combination. The section gives some additional guidance on how to deal with this situation. Once the acquirer has been identified, the next step is to determine the acquisition date, which is when the acquirer obtains control. Steps 1 and 2 are normally straightforward for many SMEs, but step 3 can take more work. In step 3, an SME identifies and recognizes the assets acquired and liabilities assumed in a business combination if they meet the definition of an asset or a liability. The assets and liabilities recognized are measured at fair value at the acquisition date. Importantly, we should note that there are some exceptions when applying step 3. In those cases, an SME needs to look to the requirements in other sections of the standard. Perhaps the most notable 2 exceptions are intangible assets and contingent liabilities. Section 18 requires an SME to recognize an intangible asset acquired in a business combination unless its fair value can't be measured reliably without undue cost or effort. Normally, applying Section 21, an SME would not recognize a contingent liability. But, for the purposes of the acquisition method of accounting, an SME recognizes acquired contingent liabilities as liabilities even without a probable outflow of cash. Non-controlling interests arise if the acquirer has not acquired 100% of the acquiree. Applying Section 19, an SME initially measures non-controlling interests at the proportionate share of the recognized amounts of identifiable net assets. So this calculation is performed after the acquirer has determined the value to recognize for the net assets acquired. In step 4, the SME measures the cost of the business combination. Remember, acquisition-related costs are not part of the consideration transferred. As we explained earlier, these costs are recognized in profit or loss unless they are in the scope of Section 11 or Section 22. The consideration transferred is measured at fair value. This includes the amount recognized for previously held interests. For example, an SME might obtain control of an entity in which it previously held 40% interest. In that case, consideration transferred includes the fair value of the 40% holding, even though the SME might not have previously measured this investment at fair value. Consideration transferred also includes contingent consideration measured at fair value, and this is now required to be included even if the outflow is not probable. SMEs are required to initially assess the fair value of contingent consideration and to include this as part of the consideration transferred. But if an SME cannot determine this fair value without undue cost or effort, the SME is permitted to measure contingent consideration at the most likely amount. Step 5 is to recognize goodwill. The calculation begins with adding together the consideration transferred, step 4, non-controlling interests, and the acquisition date fair value of the acquirer's previously held equity interest. For example, an SME might obtain control of an entity that it previously held 40% of. In that case, the first figure in the goodwill calculation includes the fair value of the 40% holding, even though the SME might not have previously measured this investment at fair value. The SME then subtracts from this figure the fair value of identifiable net assets acquired, step 3, to reach a figure for goodwill. If the business combination is a bargain purchase, the gain is recognized in profit or loss immediately. In other words, the SME recognizes a gain if the consideration transferred is less than the fair value of the assets and liabilities acquired. If an SME's initial accounting for a business combination is incomplete at the end of the first reporting period after the combination occurs, then at that first reporting date, the SME recognizes provisional amounts. Within 12 months from the acquisition date, the SME is required to adjust the values of assets and liabilities acquired if it obtains new information about facts and circumstances at the acquisition date. These adjustments will flow into goodwill. Adjustments to contingent consideration are more complicated. Sometimes these adjustments do not qualify as measurement period adjustments, and the fair value of the contingent consideration can be reliably measured. In such cases, an SME remeasures the fair value of the contingent consideration at each reporting date and recognizes any changes in profit or loss. The exception is contingent consideration classified as equity, which is not remeasured. Goodwill, once recognized, is amortized over its useful life, not more than 10 years, in accordance with Section 18. The disclosure requirements in Section 19 ask for information to help users of SME financial statements to evaluate the nature and financial effects of the business combination. Disclosures include details about each business combination in the period. These details include the name and a description of the acquiree, the amount recognized for each class of assets and liabilities acquired, and the makeup of the consideration paid. In the revised section, SMEs are also required to disclose more information about their contingent consideration arrangements and about contingent liabilities that have not been recognized. Remember, the threshold for recognizing contingent liabilities acquired in a business combination is low. When there is contingent consideration, an SME is required to keep on reporting information about this consideration in subsequent periods until the liability is settled or cancelled or it expires. Finally, the transition requirements for SMEs moving from the second to the third edition of the standard are written to make this transition achievable for SMEs. This transition approach means that SMEs don't need to restate most aspects of business combinations that happened before the date they initially applied the third edition of the standard. The only exception is for some contingent consideration for which the requirements of Section 19 have changed. In these cases, an SME would need to restate the cost of the combination and subsequent accounting for the contingent consideration. Now that we've reviewed the revised Section 19, let's look at what other resources are available to support an SME's transition to applying the third edition of the standard. The IASB published a project summary and feedback statement and effects analysis alongside the third edition of the standard. It has also published a version of the SME standard showing marked up changes since the second edition. The IASB technical staff is also updating the educational modules, prioritizing the sections that include significant changes. These modules provide support to anyone learning about or applying the standard. The updated version of Module 19, covering Section 19, is now available. Quarterly newsletters and a podcast series dedicated to the standard are also available. The newsletter summarizes news, events, and other information related to the standard. The podcasts offer bite-sized insights to support implementation. Finally, you can submit implementation questions about the standard at any time. You'll find a link to submit questions on the Supporting Implementation page on the IFRS Foundation's website. And with that, we have reached the end of this webcast. Until the next one, thank you very much for watching and listening. Goodbye.